We all know AT&T as one of the biggest telecommunications company in the world, and they also owned Warner Bros. But recently there was a spin-off of Warner Bros. And it was merged with Discovery. There's this new company, Warner Bros. Discovery, and with that spin-off, AT&T got rid not only of the company, but also they got rid of a lot of their debt. The debt went down from around 150 billion to around 130 billion. And with that movement, they also cut the dividends. And the dividends were probably the main reason for a lot of people to actually invest in this company. So the dividends went down and then the price went down because a lot of people sold the stock. So now we have to consider, is this an opportunity with the current price and the current dividends? And just recently we got the results for the last quarter of AT&T, and they're not that good. And the main thing we should concentrate on is the free cash flow estimates. Before the spin-off, the free cash flow was around 25 billion. And a lot of people said, okay, without Warner, it should be about 20 billion. But actually, the estimate of AT&T is 14 billion for the end of this year, and then 20 billion for 2023. So that is much lower than we could have expected. And that changes valuation quite a lot. So let's see, is this an opportunity right now? First of all, insider buys. Well, that's an X. There's basically no movement from insiders. They're not selling, they're not buying. There's really not much going on there. What about super investors? Yeah, there are a number of super investors that are invested in AT&T right now. So this is a mixed situation, and you should really look deeper and see what super investors are invested in this company, when did they buy, at what price, to see is this any indication for you and for your way of investing for the future. Okay. So let's see the fundamentals of AT&T. So the return on invested capital, that's an X because it's only 5.2%. But actually, if we consider a cost of capital, then it's even worse, because the weighted average cost of capital for AT&T right now is around 5.3%. So they are actually losing money. Okay. So, what about free cash flow growth? That's also an X. It's 5.7% for the last 10 years. And what we are looking for is a number over 10%. Shares buyback, that's an X. They actually issued almost 28% of new shares in the last 10 years. So that's really bad. That's diluting our investment. The dividend yield, that's a check, of course. It's 6% right now. So really, really nice dividend yield. And what about the debt? Like we talked before, they have a really big debt, and it would take them almost 9 years with the current free cash flow to pay this debt. Like we talked, the cash flow is down, the debt is down, but not that much. So it doesn't look good. The only thing that is really nice about this company at the first glance is the dividend yield. Okay, so let's try to value it. First with PE. Well, the current PE is 6.7 and the 5-year average PE is much higher. It's 22.9. But we have to remember that this 5-year average PE is actually for a different company, for AT&T with Warner Bros. But right now, AT&T got rid of Warner Bros. And they're concentrating only on their main core business. And that's probably a good thing in the long run. We have to remember about that. But this P doesn't actually represent the whole story. And we can also check the PEGI ratio, which is P divided by revenue growth with dividend yield. So the revenue growth of AT&T is 2.9%, the dividend yield is 6%. So it's a check because we end up with a number of 0.75, and we are always looking for a PEGI ratio below 1. So maybe it's valued fairly. So let's see, let's make a discounted cash flow valuation. So we have to estimate the growth for the first 5 years and then another 5 years, and we will make 3 assumptions, a low, medium, and a high one. So the low one, 3%, and then 2%, the medium one, 4%, and then 5%, and then the high one, in which we believe that AT&T is going to do really well, 7% for the next 5 years, and then from year 6 till year 10, 6%. And the valuation is all red because the current share price is $18 and the intrinsic value should be somewhere between $8 and $17. But we also have to add a margin of safety. I use 30% margin of safety, and that would mean that we should be looking for a price of around $6.60 to $12.20. And the current price is not quite there yet. So it doesn't seem like a buy. But of course, if you're more interested in dividends and less interested in the growth and the value of the company, then maybe you can consider it. And if you are interested in this company, then remember to do your own due diligence and get to understand this company better and find out little details. For example, we talked about a great dividend yield of 6%, but you have to find out, is this dividend sustainable? And if you see the current free cash flow for the last 12 months, it's 93% of that free cash flow goes into dividends. And they believe that in around 2 years or something like that, they should get down to around 40% of free cash flow that would go into dividends, which would be good and sustainable. But 93% is really scary because we're balancing here on the edge of the situation in which the company would have to actually cut the dividends because they would have no more cash to pay them. So always get more info, try to understand it as well as you can, and then make your decision about an investment. So that's it for today. I hope this video was helpful and you enjoyed it in some way. And if so, then please like it and subscribe if you want to see more videos. So that's it. Thank you very much and bye-bye.